On today's episode, we are going to take a look at 3 stocks that are down big from their all-time highs. All of them are hitting a pretty cool market. They all have a strong balance sheet and fundamentals, and analysts project that these companies within the next 12 months will give some great returns. If this is your first time here, make sure to hit the subscribe button. Don't forget to hit the thumbs up and stay tuned here on YouTube where I live stream taking a look at stocks you want me to look at. So let's get started. Okay, so the 3 stocks we are going to take a look at today are all hitting the cybersecurity market one way or another, some a little bit harder than others. But like I mentioned into the introduction, right, this is a pretty cool market. We keep seeing some form of cyber attacks happening all around the world, and I can just see the continued growth of these types of companies. The first company we are going to take a look at is one familiar in this channel already. I want to say this is Okta, the authentication company, right? This is if you have an application, if you're trying to sign in, you might get hit with some form of verification or authentication method. Okta is a company that deals within that market. Right now, Okta is traded under the NASDAQ as ticker OKTA. It's sitting at $237. And from its 52-week high, the stock has seen about an 18.6% decline. Currently has a market cap of around $31.1 billion. Some recent news about Okta: they recently just completed an acquisition of a leading identity platform for applications teams. I do believe this was a smart acquisition because it continues to strengthen Okta's current market. Now, if we take a look at their most recent earnings for Q4 of 2021, which they reported on March, we can see total revenue is up 40% compared to the same time last year. Subscriptions revenue is up 42%. What else can we see? Total customers are up 26%, and customers with over $100,000 of annualized contract value is up 33%. If we take a look at total revenue, we can see that it's not only up year to year, but it's also up quarter to quarter, and it has seen consecutive growth, it seems, since 2019. Not only is their revenue increasing, their non-GAAP operating margins have increased over time and are now sitting profitable. Quarterly free cash flow margins has also increasing over time and is trending upwards, and now the company keeps a nice portion of its free cash flow. Okta is expected to grow 22.2% on average for the next 3 to 5 years. The company unfortunately is not profitable in earnings, but they are positive in cash flow from operations. And if you guys know me, I'm more of a cash flow type guy than earnings. If we take a quick look at their balance sheet, they have about $2.6 billion in cash and about $1.8 billion in debt as their most recent earnings. Because of this acquisition, it might have shifted a little bit, but they still have a very, very strong balance sheet in my opinion. And because they're not leveraged right now, this is the last thing I want to see, a heavy leverage company, as we have talks of higher interest. If we take a look at analyst price targets in the last 3 months, there's 14 covering Okta right now. 10 give it a buy and 4 give it a hold. 0 give it a sell. So this is a moderate buy. The average price is $278, and this gives a price target increase of about 17.5 from where the stock price is at today. This was the first stock we're going to take a look at, but it's also the one that analysts expect the least from. The other 2 have some really high growth on them, even though 17.5 is definitely not bad. The second company we are going to take a look at is Crowdstrike. Now, Crowdstrike is one that's really in there in the whole cybersecurity warfare that's going on. Crowdstrike is a leading cybersecurity company protecting customers from all cyber threats by leveraging its security cloud to stop breaches. Crowdstrike right now is traded under the NASDAQ as ticker CRWD. It's currently sitting at $189, almost $190. From its all-time high, the stock price is down about 21.8%, and it does have a market cap of 42.3%. Crowdstrike, some recent news, it's also doing some great acquisitions. It recently purchased Humio, which is a leading provider of high-performance cloud log management and observability technology. Humio will enhance Crowdstrike's ability to solve real-world customers' problems with its cloud-native platform. If we take a look at their most recent earnings, which they reported March of this year, so about a few months ago, total revenue was up 82% compared to the same time last year. Subscription revenue was up 84%, so we can continue to see strong growth in these companies. they added about 1,400 new subscription customers in the quarter for a total of 9,896 subscriber customers as of January 31 of 2021. And this represents an 82% growth year over year. It's insane how these companies are continuing to grow. If we take a look at future expectations, this company is also expected to grow at great levels, right? 22.9% on average for the next 2 to 5 years. Okta was 22.2, right? So they're all high growth right now. Unfortunately, Crowdstrike, just like Okta, is not profitable, but they are positive in cash flow from operations, and they do keep a good portion of that cash. If we take a look at their balance sheet, it's almost a similar story to Okta, where they hold a nice amount of cash, 1.9 billion and $738 million in debt. So they're not leveraged, and that's what I like to see. If we take a look at analysts, there are 18 looking at the company. 15 give it a buy, 3 give it a hold, 0 give it a sell. The average price for the next 12 months gives the stock price an increase of 32.8% from where the stock price is at right now. And the reason I am doing this episode today is because of articles like this. I feel like they have become more common, where some form of company or country or enterprise is being attacked by some form of cybersecurity threat, right? So I want to take a look at 3 companies that are somehow working in this market, trying to see one way or another to protect either the company, a country, an enterprise, for example, right? And all 3 are helping one way or another. All right, so the final company we are going to take a look at is ZScaler. And ZScaler, I also think, is hitting this market pretty well. But before we begin, let's take a listen to today's sponsor. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the stock advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. The best way to explain ZScaler is, let's say you are signed into your company's website, you're trying to VPN into your company's website from either some form of device. ZScaler, you go through ZScaler first, or here, right, you're starting from your branch, your headquarters. Before going into the public internet, you go through ZScaler's security platform and make sure that your device is secure throughout the way as it's checking other portals, or the other way around. Let's say you're logging in from your phone, you have to go through ZScaler's security platform first before making it into your company's network, making sure that your device is secure. So ZScaler right now is traded under the NASDAQ as ticker ZS. In the past year, from its 52-week high, the stock is down about 25%. It currently has a market cap of $23 billion. Is this the smallest one we're seeing so far? Yes, it actually is. Some recent news on ZScaler: in their most recent earnings, which they represented in February of 25th, revenue grew 55% compared to the same time last year. Huge growth all around. Cash provided from operations now represents 19% of their total revenue, where a year ago it represented 5%. Free cash flow now represents 11% of their total revenue compared to negative 2% last year. So you can see the overall growth of ZScaler, just like the other 2, is also making acquisitions. On April 15th of 2021, they announced that they are acquiring a cybersecurity startup company. Now, if we take a look at future growth, ZScaler is expected to grow 24.4% on average for the next 2 to 5 years. I think this is probably the biggest grower out of the 3. Yes, it is. They are not profitable in earnings, but like we saw, they are positive in cash flow from operations. If we take a look at their balance sheet, very similar to everything else we've seen. They have a nice amount of cash position, 1.4 billion, and about $900 million in debt. So they're not leveraged. Again, this is what we want to see. Now, if we take a look at analysts, there's 20 looking at ZScaler, 15 give it a buy, 5 give it a hold. So this is a strong buy. The average price is $236. So that gives it a 41% increase from where the stock price is at right now. Now, I wanted to take a quick look at valuations as well to see how they're doing. The first thing I'm noticing is that ZScaler is the most expensive out of all of them. ZScaler has the highest gross margins out of the other two, and the other two are pretty tight to each other because they have similar margins. So they're all pretty much priced very, very similar, but we can see they are a bit cheaper from where they were earlier on in the year. So that's great news. And I do believe these are great companies hitting a strong market. All right, so now let me share my overall thoughts on the three companies. First, all three companies I think in my portfolio would be a tier 2 stock. And I don't think I have a preference of one or the other. I just enjoy the overall cybersecurity market. And these are some ways I can enter, even though they're all hitting different parts of this cybersecurity world. They're all companies that I believe can continue to grow as time progresses. We saw from their valuations, even though they are cheaper from where they were a few months ago, they're still kind of a little bit higher than they were a year ago. So for me to enter any of them, how would I do it? Just how I do anything else, dollar cost averaging over time and building a position over time. Sometimes I might enter high, sometimes I might enter low, but that's okay because overall I do believe this is a market that will continue to grow. So I hope you guys enjoyed today's episode. Take care, have a good night, and see you next time.